So that first lien position means you're in control. Means I get paid. It's not like if they go bankrupt, like I get only half and the second gets half. No, I get paid everything and whatever's left over goes to second. So I do first because we're in control, meaning we care about the property and understanding, hey, what's the value of that property? I view it, seconds, I view you more as a therapist. Where I got to figure out what's the borrower going to do. They're going to file bankruptcy, going to do this, going to do that. And first, I don't have to be that therapist. It's like either work out a plan with us or we'll go after the property. And I say that not to mean like we're just going to jam it down their throats. That's not what we do. We actually try and work out most of the time with the borrowers in buy occupied properties. We have probably less than a 10% foreclosure rate on our properties.
You're listening to the Accredited Investors Only podcast, presented by Accredited Life.
Chris, welcome to the show. Thanks for being here. What's happening? How you feeling this morning?
Feeling good, Peter. Thanks for having me here. As we talked pre-recording, little chillier over the last few days on the East Coast than it's been the last few weeks, but doing really well today.
Definitely. Yeah, this is a good way to wake up. You feel that cold, crisp air. It gives you some energy, right?
Yep. No,
but not as easy to stay in bed unless I guess the blanket's nice and warm. But for me, when you wake up and you're cold, it's like, all right, let's get going.
Yeah. Well, it's interesting too. And, as you get older, some things don't change. And when I walked out this morning, you just like breathe the air and smell. Reminded me of days when I was back in high school playing football, those cool fall days of like, and I just want to be outside today. And, I'm glad we're here recording the podcast, but I already put on my calendar today. I'm like, you know what? Being an entrepreneur and I'm running my own business, put 30 minutes in there. I'm just going to go for a walk. So,
yeah. I was watching the news the other day and they had it was a story. It was like the local news. They had a story about, I think they called it like sunshine regret or something like that. The people on a really nice sunny day, they have regret of not going outside. Are you that kind of guy? Because I felt like, I don't know if I've ever felt that way. Like, because it's like, it's going to be there tomorrow, right? Or
yeah, and that's I don't get the regret, but reality wise, there's not much in life I really regret because you can't do much about it. You can learn from your mistakes on things. Are there days where I wish I was more outside? Of course, but I'm not going to let it beat me up. I'm like too busy to there's so much more to look forward to.
Oh, I think that's such an important mindset because I thought that was a funny word to use. I'm thinking regret. Like, I don't know if I would look at it that way, but I'm sure now I think about it, I probably know some people who would, and so I think that's a good mindset, especially for an entrepreneur. Before we get into things, Chris, why don't you give the audience a little bit of background on yourself and where you come from and what you're doing now, that kind of thing.
Yeah. So I'll start with today, what I'm doing today, and kind of rewind it backwards from there. Today, we run a real estate fund that is investing in performing and non-performing mortgage notes. So we've launched our company, this fund 2 years ago, and that was built upon 5 prior funds that we have done in the past. And I got into the note investing space and starting my own business somewhat by accident. I blame my wife. Blame the wife. Well, first, COVID was really kind of the game changer for me that made me want to, or a component that wanted me to start my own business because you're working from home and be able, really see what it's like. And then like, do I really want to go back to the office? But that was really spurned earlier upon. I've been in real estate since the late 90s, graduated college, civil engineer, worked for a large commercial general contractor as a project manager / project executive. Then ran several multifamily divisions for certain companies, and then worked for a large family office that had about $3 billion in assets under management. So I've been experienced at all things real estate, and I got to work around a lot of really high net worth individuals. Now, the companies that I work for were all, individual or family owned. First one, single owner. Today, he's probably worth a few $1 billion. The family office was a few billion. And then one of the real estate development companies I work for, that owner is probably worth, 100 to 250 million. And I don't say that to brag. I say that because I was able to see a lot of these companies that were in a growing phase, what they did, how they managed, and how they led. And I think that's important to understand as we talk about like accredited, investing and, the sponsors and so forth. And you mentioned before this, you were talking to somebody yesterday about the different types of sponsors. And really that background of, I got to work with so many awesome people and learn from, people that it just has given me what I think, some advantages or some experiences that I've learned to, and also I can pick up the phone and call them and ask them, hey, how have you handled this in the past as well? Um, so that's kind of the long of the short of, and the last thing I'll mention, how I stumbled in note investing was, my wife and I were building our primary residence. We finished it in 2013. And then we had a boatload of equity because we were acting as a GC. It was the time the market just, started to peak. And we started buying rentals and we were, rehabbing properties. And we had 2 kids at the time. And my wife's like, too much work, find something else to do. So me being kind of the person who can find anything on the internet, I stumbled upon note investing. And I was actually pissed the first time I found out about it because I didn't realize you could buy defaulted loans and you work for, in that business as well. And I was like, wow, this is awesome.
Yeah, yeah, that's I've been on the receiving end of, wow, this is awesome in that business so many times. I mean, for me, it was like that was my first introduction to real estate investing.
Yeah.
So it was like second nature, but like there was so many people that I would deal with who were doing, your thing there. I mean, they were buying and fixing up houses and doing rentals and things like that. And then when they saw what you could do with distressed mortgages, especially if they were looking to be more passive, but they were looking to, they didn't want to invest in a fund or something like that. You know what I mean? It was like, oh, this seems like a nice little, this is something kind of in the middle. But man, I love what you're saying about the companies that you work for, the family office, because a lot of times I see, on the internet and on podcasts and things like that, these fund managers and syndicators who, I joke, they were working in IT 6 months ago. And I don't think there's anything wrong with that to some degree. You know what I mean? Like, I get it. Every real estate's great. Why the heck would you not want to be in it? Right. You know what I mean? So it's just like, I get that. But at the same time, like for me, having similar, not working, with family offices, but I've been getting more into that family office space and going to some conferences and things like that. And it's a mind shift, it's an eye opener. But I go back to like past experience and, working at a fund and, a lot of times in my business today, I'll think back, what did we do back then? You know what I mean? And what was, is there some kind of scenario, some experience, something that I can tie to this? And then would I want to replicate that? Would I want to do something differently? That kind of thing. So I think to myself, man, if you're coming from a different industry completely, not that, you couldn't maybe cross, over some experience and things like that, but to not have that experience, I mean, that's got to be tough sometimes. You better have somebody you can pick up the phone and call, right?
It is, and it's interesting because I actually posted a blog post today of, on that question exactly because there was that syndication down in, I think, Houston that got in trouble. The guy took the famous guru multifamily training. I won't mention names, and if when they went under, and again, I love digging up dirt on the internet. My retirement life, I'll probably be like a private investigator. So I go to his little website and I look at the guy, and then I go to LinkedIn. And top 2 things is he's in IT and his business partner's in IT.
Yeah.
Okay. But I will say IT people are usually much, much smarter than real estate people. That doesn't mean, but that doesn't mean that one transitions to the other. It's like being a doctor to going to a mechanic or a mechanic being a doctor. Both of them are very specialized. Now, and then I dug a little deeper and I was like, oh, asset managers. And then I look at the 2 asset managers and they're 2 young women who I, then, click on their LinkedIn profiles. They're virtual assistants out in Asia. And I'm sitting there thinking, how is an asset manager not, they've probably never been to the US, probably never invested in real estate. They're virtual assistants, but they put them as asset managers. And, one of the things that we're seeing a lot of these deals go bad. And I do think it's inexperienced operators, but for the people who are listening, the accredited investors out there, 80% of, when things go wrong could be spotted early on.
Sure.
And what I mean by that is, I got an email this morning from a company, a real estate company, proven model, industry proven business model, IRR of 50%. And it's like delete.
In real estate, yeah, wow.
Yeah. I mean, anytime you see anything that is just looks too good to be true, and there was a company that called Drive Planning. I don't know if you've heard about them.
Hmm.
They had this thing called the REAL program, Real Estate Accelerator Loans. They raised $300 million in the last several years, and they were offering 10% per quarter return, and they were paying people to bring in the money. I think it was like 4% or 5% per quarter. So they're giving up 60% IRR per year to invest. And I'm like, there's no business that can make this much money. It's impossible. I'm like, I see what they're doing. And lo and behold, the guys basically, SEC shut them down and realized that the wife spent like $1 million at like Louis Vuitton. He bought all these properties for himself, legend. But of 300 million, like 200 plus million was gone to whatever. And, people were like, oh, I can't believe I fell for this. And if it's too good to be true, it is, people. It is. I'm telling you, it's, you run a fund, I run a fund. It's not easy. I don't care what anybody says. It's effing hard.
There you go. Well, you hit the nail on the head, and I think so many people, so many accredited investors now, there's communities are popping up all over the place. And a lot of times they're like LP run communities. And I think there's something to be said for that. But at the same time, it's like, and I think a lot of times they're talking behind the scenes about operators and things like that. And there's a time and a place for that. But at the same time, like, don't be missing the operator's perspective, and make sure you have good relationships with operators, that when you're looking, people call me all the time and say, I'm looking at this deal or that deal. And I can look at it from an operator's perspective. Like, I had somebody who was in what I like to call like a Fox News fund. It was one of those, they're paying for prime time, like, 9 o'clock. This was back with like Tucker Carlson, so it's like they have to be extremely expensive ads. And then to your point, they're paying like 27, like high 20s or 30s IRR. And you're just thinking, and what are the deals? They're like value add multifamily deals. It's like, there's no way that's sustainable. So, but if you don't have any like perspective, and you haven't worked in the business, and you're not on the operation side, you don't know what you don't know. That kind of thing. So you're giving some great insight for accredited investors on kind of how to do their due diligence, how to poke around online and stuff like that. And then like kind of, put their detective cap on, like you said, like your private investigator, you need that skill set in order to kind of sniff out the bullshit, right?
Yeah, and here's the interesting take, because I'm an accredited investor and I've invested in the past. And before I kind of did my funds, here was my thought process. I viewed being an accredited investor as like making it to a certain level. Okay, I make this much money. Where it's like flying first. It's like, oh, now I'm like flying first class. And it's like, oh, so now like I get better opportunities. I get better deals. I get like treated better. That's the mindset I had of being an accredited investor. And the reality is, it's the exact opposite. And what I mean by that is, as a non-accredited investor, hey, look, you're open to now Regulation A out there. So there's some offerings that you can invest in there. But usually it's like, okay, I'm open to the public companies, which again, transparency is what they must follow because they are so heavily regulated.
Sure.
When you're accredited, all bets are off in regards to, they don't even need to have a PPM. They usually put one. Whatever's in that subscription agreement is kind of like, hey, we're exempt from the SEC. What we say in the subscription agreement and the PPM is kind of what we can do, as long as, of course, it's illegal. But there can be, things in there that are, so many stipulations that are just so lopsided and one-sided.
Yeah.
And I didn't know that. And again, so I started having my attorney review some of these things, and he's like, whoa, like, you realize, like, the fees that they're getting, or like what would happen if they go into default. And again, I'm sitting there thinking, well, now that I'm accredited, I'm sitting in my first class seat, so I should have the best deals. No, you're just at much more risk and need to really do so much more due diligence.
Yeah. Yeah. Wow. That is a really good point. And yeah, what very good perspective, because you're 100% right. Those Regulation A, crowdfunding type sites, there's a lot more regulation that goes into that. You know what I mean? So that they have to do a lot more reporting and financials and things like that. But if you're in the Reg D space, yeah, you really have to come to know and like and trust your operator, because there is definitely, they don't there's a lot of things they don't have to do. And a lot of times, if you read those ppm docs, it's 90 pages of risk disclosures and things like that. And how many times do people even take them seriously or even read them? You know what I mean? And I get it all the time, where people ask me questions and I just think, I know you haven't read the ppm, because it's right in there. You know what I mean? Like, what's this, or what's the fees, or what's this or that, and it's just like, it's right in there. But people just, they don't read them. You know what I mean? Like, so it's what are you gonna do? One of the points of this show and the community behind it is that when you become an accredited investor, it's not like you get a handbook, from the SEC or something like that. You know what I mean? Like, to your point, it's like you're just thrown into the ocean, and if you want to play in the space, like, you gotta have to educate yourself, and it's tough. You know what I mean? So, getting back to your story, how did you get into the note space? Like, you said that you were doing the rentals and things like that, and you were good at finding things online. Did you find an online course or something? Because I think this could help accredited investors, like, find a way how you got into that and all.
Yeah, and it's interesting because I found it through Bigger Pockets, and originally I started doing some tax liens. And I was like, okay, this is like watching paint dry. And again, as an engineer, I'm a problem solver, and I'm always looking to how can I put myself in a competitive advantage. I'm the type of guy who works freaking 20 hours a day, has no life, but I love what I do.
Sure.
And I put in the work and the grit, and I'm like, okay, I know I'm going to work harder than everybody else. So with tax liens, I was like, I can't get any advantage because of that, because there's no real benefit. And then in the same forum post, there was about mortgage notes. And I saw it and I started listening to a podcast that's no longer around about it. And then that person mentioned another guru who I started, listening to their videos and so forth. And, started like learning from that person. And unfortunately, I had to disassociate myself with that person, because while they had a lot of good training courses, the person was just, and this happens a lot in any type of business, when the lead person is just a really good marketing person, but no good management skills,
Yeah.
things go bad. And this person was buying a lot of loans. He was raising money to individually, and basically all his deals went bad. He has $2 million in judgments against them. And today, Bill does all these courses,
Yeah.
but has never really isn't paid many people back. And he's got judgments and everything against him. So
I know exactly who you're talking about.
yeah, okay, yeah, he's out of Austin, and
Yeah. There
yeah,
you go.
you don't want to associate yourself with somebody. Your reputation is so key. So that's how I got stumbled upon notes, and I just took it slow. I realized, and I've been in real estate, it's like when, I used to build a building. Hey, it doesn't happen overnight, and I built some buildings pretty damn fast, but it's still a journey that you have to go on and just follow a process. And that's what I did with the notes, where I bought 4, worked them out, waited 6 months, started buying a little more. And then, I'm an engineer, so I'm not the great marketing person, but I started a podcast and I was telling my story. I don't sell anything. I just provide a lot of content. And I think a lot of people can resonate with that, because a lot of people go on that journey of trying to find a niche or find something they want to do. And that's what I did. And I would share my story. I'd share also, people love horror stories.
Sure.
You've been in notes, you know, there's a lot of horror stories in notes. I would share those. It's not all about, oh, I bought it, I got them paying in, I sold it, and I made all this money. Yes, that can happen, but what about the time, that somebody passes away, and are you going to foreclose on a mom that has 3 kids at home, or basically they burnt down the house the day before the foreclosure, which is actually like, thank you very much, I get the insurance money. There's all the horror stories that were involved. So, that's how I got started. And that's kind of how I grew my business. And the biggest mistake I made growing a business was I thought I could do it all. And the moment I brought on a business partner and an additional, and now grown my team to, it's myself and 7 of us, within our fund, and we've got 700 plus investors, is, we have people who are experts at everything. And, I think that's one of the things is people, accredited investor, when you ask a sponsor is, what do you do in-house? What do you don't you do? What is your role in this? Is this full-time? Is it part-time? And, understand that it's not my first funds. I was working still and I was doing them, part-time. It's not a bad thing. You just need to understand that because
Sure.
it has another layer of risk. So.
Wow, you hit the nail on the head. I was literally just having that conversation with somebody yesterday where I got off of an investor call, and you have those calls where you just know somebody has a list of questions, that maybe they found them online or maybe they came up with them themselves. And it's just like, I'm just thinking they're asking all the wrong questions. You know what I mean? It's what I like that you have to, there's the logical side and then there's the emotional side. And a lot of times, depending on who you talk to, they might just stick completely on the logical side or completely on the emotional side. And I just think that's so important to know, what is it that you like to do? You know what I mean? Like, what's your skill set? What are your strengths? What's your weaknesses? Do you enjoy what you're doing? Because I'll talk to guys who are, a lot older than I. They've been in the business for 30 plus years. And like, they have that, like, where they're like, yeah, when you're doing it this long, you're not going to like it either. And I look at my father, who's a property manager, and he retired during COVID, and at least once a day, maybe or a couple times a week, he's like, man, I wish I was still working. I miss it. Yeah, I miss this and that and all. And I just think to myself, like, that's not everybody. I mean, so I'm always curious, how passionate are you about what you do? And then, the people on the team, I think is so important. I learned that early on, pretty much day one with where I was at, where they had 3 partners, and then, and each one kind of did their own thing and they stayed in their lane. That is really, really crucial, because I like to say it's capital, acquisitions, and execution. They're kind of like the 3 pillars, and everything falls into that. And to your point, a lot of times when I see a fund or a syndicator that's really good at the marketing side, it throws up a little bit of a red flag, because like, and it's not like you shouldn't be punished for doing something very well, but it makes me want to understand, are you good at the execution side too? Because a lot of times those guys who are the walking spreadsheets aren't necessarily the most comfortable on a podcast, or they're not the best at coming up with like a blog article or a LinkedIn post about what it is that they do. They know what they're doing, but getting it out and on the paper is painful for them. You know what I mean?
Oh man, my business partner Lauren, she's the exact, she actually was a note investor as well, but we're the exact opposite. She comes from a sales background, and if somebody asks us both the same question, she'll be clear, concise, and answer it, and in a manner that it should be answered. As if like you're on TV or on a podcast. Like even this podcast here, every answer I give just keeps going and going and going. And that's because that's an engineer, and I just go so deep into everything.
Yeah.
And some people like that, some people don't. But like what you touched upon is, some of these sponsors, like, there's one right now who's in a lot of trouble. They have a Regulation A offering, which I stay in tune with. We have a Reg A offering as well, and I know that space really well. And they have one, they haven't done audited, they're under investigation. And all I see now is ads of the CEO about his next guru webinar, guru training, flying around the country. And I'm like, okay, if you're a CEO of a failing company or allegedly failing company, what are you doing flying around where you got 200-300 investors who are all pissed off at you, but they get an ad from you that, hey, come to my conference and pay 10 grand so you can listen to me speak. And I'm sitting there thinking, what are you going to talk about? How to bang? Yeah.
And wow, that is, and you see it. You know what I mean? I think to be a really, really good on the marketing side of things, to be able to do that, you have to be a little bit of a sociopath or something like that. I don't know what the exact word is, but it's like you have to. Yeah, some of these people where they just have no shame, it's unbelievable. So, well, let's get back on topic. There's so many different flavors of notes. This is one of those things where, back in the day when I started, we were doing second mortgages, and we transitioned to first. And I think a lot of people just think like, oh, you went from seconds to first, it's like, whatever, I mean? It's not that big of a deal, but that was actually a massive uplift, you know what I mean? Like now, with seconds, it's a lot of workout agreements, it's smile dial, talking to homeowners, trying to get them to stay in the home, get them on a payment plan. In first, especially with the first that they were buying at that time, it was a lot of vacant homes. And I mean, borrowers were deceased. So you're exiting through the property itself. And now you're doing, more physical, property and asset type management, and workout agreement. There's nobody to call to get a payment plan, that kind of thing. And then you have the distressed mortgages. You have, non-performing and all. So what is it that you're focusing on, and why, right now at this time?
Yeah. So I am a complete control freak. So we do first. And, with first, and again, for people who understand lien position, think about waiting in line, for food. I remember in middle school, like Fridays, I want the grilled cheese sandwich. It was tuna, peanut butter, which they gave peanut butter back then. You didn't have allergies, but nothing else. I mean, we were just plain peanut butter, which is, and then like grilled cheese. Like, which one do you want? So everyone wants grilled cheese, so you need to be first in line. So make sure you got it. So that first lien position means you're in control. Means I get paid. It's not like if they go bankrupt, like I get only half and the second gets half. No, I get paid everything, and whatever's left over goes to second. So I do first because we're in control, meaning we care about the property, and understanding, hey, what's the value of that property? I view it, seconds, I view you more as a therapist, where I got to figure out what's the borrower going to do? They're going to file bankruptcy, going to do this, going to do that. And first, I don't have to be that therapist. It's like either work out a plan with us or we'll go after the property. And I say that not to mean like we're just going to jam it down their throats. That's not what we do. We actually try and work out most of the time with the borrowers in buy occupied properties. We have probably less than a 10% foreclosure rate on our properties, because of the loans we try and target, which are borrowers that have, been in their home for 10 plus years. They didn't buy their house during COVID, so the values were overinflated, or my view, overinflated. And usually we look at, they either had a, death, disease, divorce, or temporary job loss. Those are the four main factors that happen to somebody that causes them to stop paying. Most people don't wake up one morning and say, you know what, I'm not going to pay my mortgage today. It's like, I'm not going to my goal today is not go to the gym, not pay my mortgage, and drink a six-pack. Like, that's not what people do. Maybe two of the three, but not all.
Very few, but not the majority, right?
So, yeah, so that is our focus. We also do, as part of a portfolio, and this kind of, again, balances as a fund manager, there's owning an asset and then there's a portfolio, and there's the whole portfolio management side of things of balancing it so I don't have all the risk in non-performing. We have a pool of performing loans as well within our portfolio. We like right now, because of the market shift, to keep those more short-term loans, like bridge loans to investors, that, it's not like a first-time investor doing a fix and flip. No, we've got one where a guy owned a property outright and wanted to go buy another one. It's like, okay, we'll give you up to 40% LTV on this home, secure it for 12 months, and interest-only payments. That way it keeps the money coming in the door, but it gives us liquidity. So those loans are short-term where we can do them or pivot, because the non-performing market over the last few years, just like real estate, as it is not completely dried up, but it's not as lucrative or not as many assets as there was, a few years ago. I mean, it's never going to be another 2008 to 12. I mean, people, that's the first question they ask. Just pretend that didn't exist because it ain't happening again. Kind of like
I get that question. I get that question a lot, and I think it's probably just one of those list of questions that you have. You know what I mean? But it's like, are you following anything? It's just like, it's a totally different environment now, and it's just a waste of time to ask that question right now. But I get it, and you want to know. I mean, what's this person's plan, and how do they answer it, that kind of thing. But it's just, there's the factors in the environment are a lot different right now. So how have things changed for you over the last couple of years? I was in a note fund in my IRA that didn't go. It was going smooth for quite some time, and then they didn't pivot. They were buying a lot of New York assets and stuff like that. They were getting it cheap, and like they didn't see the writing on the wall. You know what I mean? And it just scratched my head, and then COVID hit already, obviously a long foreclosure timeline in that state. With COVID now, it's like, there is no timeline. I mean, they have no idea when they're going to be able to. So all of a sudden, the value of those assets decline. They have a hard time selling them, that kind of thing. So how has your business over the last couple of years, how has it pivoted? And I think it's important people understand with notes is the price is going to correlate to the asset value. So like to your point, right now when equities all time high, I mean, prices are at a high, note values are going to go up. I mean, that kind of thing. So I think that's an important thing that people don't always realize about how loans are priced, that kind of thing. But how have you seen, like, how has your strategy pivoted over the last couple of years?
Yeah, and great question. And it's, you're constantly pivoting. One of the benefits of being in the note space is ignore what's going on in the media. Data is the data. And as a lender, you're at the front of the lines. I am seeing people, like I know some people who invest in seconds, who they bought a bunch of non-performing seconds that the people got lines of credit to pay off their credit card debt. And the people just went and racked up that credit card debt again because the people are like the government and have a spending problem. We're starting to see the impacts of in this insurance, taxes, and just inflation really starting to hit. And people's salaries have not kept up with all the costs of owning a house. Granted, you have all this equity. So there's a report that just came out. Oh my God, the US has like 15 trillion or $30 trillion or whatever number is in equity in their homes. That's great. But if you can't afford the payments, you're gonna have to sell it and downsize, or you go into default and then it gets sold at a discount. So, understanding, like seeing what's coming up ahead. One of the pivots we made was, again, on these performing loans that we had in our pool, usually they were owner occupied homes. And, we, have a segment of performing, but I start to see, and we like to try and say at the entry level to middle class homes. So those are the people I think are starting to get hit most. And we shifted away from those because if you buy a loan that's performing and it goes non-performing, it's like buying a house that's fixed up and having your tenant trash it. The value has now gone down and, you could lose on it. So we pivoted a little bit to some of the private lending side where we get the personal guarantee and we're lending to people who, have significant money. They're using it, wisely, and they know how to manage money. So that was one pivot shift. You mentioned the same thing of, we were doing a little bit in New York and some of these other states. State laws have changed significantly over the last 4 or 5 years. And that's mortgage notes is very state specific. We've started moving out of completely, for example, 5, 6 years ago, I probably had 10% of my portfolio at least in Cuyahoga County, which is Cleveland. I think I have maybe one asset left that I'm trying to get rid of. We would have a little bit in New York. We don't have, actually, I think I have one asset, but it's an investment loan in New York. Some of these states that are just so onerous to deal with, we're like, you know what? We're just getting out. We're not, getting involved in those states. And a lot of note investors love Florida. And I don't know why. They just think of the appreciation which they've had over the last several years, but actually a very challenging state to foreclose in. There's actually attorneys now who basically will see a foreclosure filing and go represent the borrower and file counterclaims against you to fight you. And, when this, right now we're recording this is a major hurricane, barreling right down, the path of Florida. So, we're just really cautious in regards to, where we invest in some of the stuff that, we do pivot on. And kind of previously, again, we used to buy more non-performing loans that may have been vacant that we might do some repairs to or whatnot, which I'm not a fan of because I've been in construction and it's hard. But again, cost of construction, cost of materials, everything has significantly gone up. So now something that used to cost 20 grand to, do what I'll call a powder puff renovation, which is paint, carpet, and clean it. Now, that may have been 10, say it was 10,000 or 15,000. Now it's 25 to 30.
Yeah.
And trying to find quality tradesmen to do it is even harder.
Sure. Interesting. Yeah. So we're buying very, very different things on the note side of our business, where it's like vacant, HECM loans, where the borrower's deceased and then touching, 90%. You're going after more of the occupied, and the first, goal is to get a payment plan. Awesome.
Are you going to be bidding on the HUD HECMs that are coming out?
Yeah. My partner Wade has been in due diligence, and that is always, it's amazing, the due diligence process and how tedious that is. Talk to me about your due diligence process, because it's probably a little bit different, but I would think very similar. You got to know the value of the asset at the end of the day, right? Backing that note.
Yeah, and we're actually going to be looking at some of those HECM loans as well. Strategically looking at a few of them in kind of like my neck of the woods or specific areas that we have. For people listening, a HECM is a reverse mortgage where the borrower, when they pass away, if there's no equity in the property, it essentially just goes to foreclosure. So you don't have to worry about, the borrower in those instances. But yeah, for us, the due diligence process, very in-depth of, I like to say we look at the 3 Ps: the person, the predicament, and the property. The property is, okay, how's the title look on it? They paying the taxes, there are other liens. Then the property condition, which again, we can't walk inside these properties, but you can still get a pretty good feel for how the exterior is taken care of, and, that
Sure.
side of things, what it is. The person, have they filed bankruptcy 5 or 6 times? I think my record is 8 or 9 is what I've seen. The person I've seen, and this is where people like the horror stories. Some of the I've seen people convicted of things that I didn't even know existed. I've had actually 2 loans that the people end up committing murder on.
Yeah.
So in that instance, which they were clean before then, but I've also seen ones where the person's, done certain things to animals, had an animal fetish, which, I just saw when we pulled their police record, just like, wow. Wow. Just some of these stories. And then it goes back to what I mentioned, that predicament of why are they in default? What caused them to be default? Was it, a job loss? Was it a death, a health issue? And there's professional borrowers out there. And when you see multiple bankruptcies, multiple, lawsuits against them or criminal histories, that's not the type of person we're probably going to be able to work with. Someone else may want that to foreclose and go back and take the property. For me, I've owned real estate. We're not really, I'm not in the real estate owning game. I'm in the, hey, let's work it out, get it reperforming, and sell it back on the market.
Mm-hmm. Gotcha. So getting back to something you said earlier, with your past and working for a family office and working for other companies, I think that's something that not everybody has the experience of doing that. So what would you say is some of the skills or some of the things that you've brought with you from that life into what you're doing now?
Risk mitigation and risk management, 100%. Construction, development side of things. In construction, it's, you want to get the building built. But when I flipped over to developer and put on that developer hat, the first thing they always said is, what is our risk management plan? We want to make money on this, but our biggest thing is we don't want to lose money. How are we going to preserve our capital? Same thing with a family office.
I was going to say, it sounds like exactly what a family office would say.
The same exact thing is, and you see some of these deals of, okay, you can get a 20% return on this. A family office, depending on the type, there's VC ones that they'll go for the home runs, but a conservative family office would say, I'd rather get 8-10% every single day with very little risk, or not getting that phone call of something major happened, than riding the roller coaster of, ups and downs. Because they're just, they have, somebody's got $1 billion, at, let's see, 5% a year, that's 50 million. If you can't live off 50 million, you probably got bigger issues. But they're just continuing to grow and preserve it when they get to that level. But when I work for the developer too, that was the biggest thing of, how are we building this? So, especially condos, how are we not going to get sued? Because there's always going to be a condo association lawsuit. How are we going to fight against it? And basically, what is our standard of care? that we're going to be doing within it. And I think that has been the biggest thing for me as part of I manage a portfolio is, okay, what is the risk management? Because it's my money, but it's also the investor's money. How am I preserving that and how am I keeping them out of risk?
Yeah. Wow, that's amazing. That's really good information, and it's one of those things where you see a lot of podcasts and like articles and things like that, like invest like a billionaire, and it's like that might work for some, especially if they're risk adverse and things like that. And to your point, the billion, it's going to depend. You know what I mean? Like it's just like it sounds good, I guess, but it's like depending on what your goals are, that might not be the best path for you.
No,
Mhm.
but yeah, there's two types of investments you can have, and I recommend everyone diversify. There's the equity play, and then there's an income play.
Yeah.
But don't mix the two. And what I see where people make the mistake is the equity play is, hey, look, I'm targeting the higher return on this deal, knowing it's higher risk. But what I see a lot of times is people will take an income play, and it's really the sponsors treating it almost like an equity play. For example, there was a note fund that was offering 17% plus like a 5% kicker as well. And I'm
Mm.
sitting there looking, how can a note fund give 17%? I mean, you can't. Okay. And, when everyone else is given 8, 10, 12%, whatever the magic number is, they're at 17. I'm like, it just can't happen. And people are investing because they see that great number
Sure.
and they're treating it like, oh my God, and they're going to pay me monthly too as an income play. An income play is not going to get you, 17 to 20%, or
Yeah.
there might be one or two of them, but an equity play of a multifamily deal, hey, it's an equity play where it's appreciates, they sell it, and I, get a pref plus the upside, and I'm going to target 16, 18, 20, whatever the case may be, better times it's better. That's a good investment. That's not a bad investment. But, and you want to be diverse, but you have to understand again that an income play is an income play, but if it's providing equity type returns, kind of have to scratch your head a little bit.
Yeah, that's a really good point because I think a lot of investors they want every deal to fit, all their goals at once, and it's just like you have to look at things from a portfolio perspective and not just every deal. That not every deal is going to have that. And to your point, if it is, probably something is wrong there. You know what I mean? Because go for it.
Well, I've seen people who look at us and, our funds, 8 to 11%. And, someone once wanted to invest and they were in the 10% bucket and they're like, well, I can go invest in, buy this other one that's invested in seconds or buy a second position and get 12%. And I'm like, yeah, but you realize you're in second, you're 90% LTV and, all the other component. I'm like, is that, and I'm like, at $100,000. Is that $2,000 delta in return worth the risk of being in a first position at a 45% LTV or second position at 90?
Yeah.
And that's where people, it doesn't correlate up there because they're just looking at the sexy, shiny number of this is what I'm going to make. I'm like, no, that's not what you're going to make. That's what they're hoping you're going to make. There's a big difference.
Yeah. Yeah, that's amazing. Yeah, that makes a lot of sense. And I do think people get caught up in the numbers in that sense. And it's you got to put things into perspective. It's like how much are you investing and then how much is that X amount of difference making and then adjusting it for that. That's risk adjustment to the T right there.
Well, it was interesting because that fund I mentioned, I was providing like the 17%. There was a forum post about it, and somebody took a poll of when they invested. And basically, like 80% of people who were in this group, or a large percentage of them, which is, let's see, what's 10 plus $1 million, however many figures that is, all invested when he went from 12 to 17%. Because originally, is it like 12? When he went from 12 to 17% is when everyone invested.
Really?
And I guarantee you, not one of them asked the question, well, how is it when you're at 12? Now you can give 17. What has changed or what has changed in your model?
Yeah.
And unfortunately, people, probably just were like, oh, I see 17. Oh my God.
Yeah.
That one that was offering 40%, one of those people came on one of our webinars and said, you provide 10% per year or, target 10%. I can get that per quarter. Why can't you give more? And I basically chatted with them offline and I told them, there is not a company in the world that I'm familiar with that can consistently provide a 40% return, especially in real estate.
Yeah.
You know,
Must have been investing in a drug cartel.
yeah. I mean, we could get it there, but
That
yeah. So, and
That's
lo and
amazing.
behold, a person like, well, I invested and and they've been paying me. And I'm like, yeah, and now it's been proven that they were running a Ponzi scheme. And next thing you know, when they call you back, knock on your door and start clawing some of that money back,
Mhm. Yeah.
you're not going to be happy about it.
Yeah, just because they're paying, I've had that conversation a lot over the years. Just because they're paying doesn't mean it's working, and that's how every Ponzi scheme is based on you getting paid. That is a crucial part of it. So, Chris, what an amazing conversation. I really enjoyed talking to you. So many different things we can dissect here. I'd
Mhm.
love to invite you to the community, and we could take this conversation deeper. But for now, how can the listeners find you and get more information and learn more about your funds and all?
Yeah, so they can go to 7einvestments.com. That's the number 7, the letter E, investments.com. You can email me at chris@7einvestments.com. I can also listen to our podcast, Creating Wealth Simplified. We talk about a lot about note investing and kind of, again, mistakes that people make. It's very similar to this podcast. So, those are the major ways. There's only one other Chris Seveney. So if you Google me and find me on LinkedIn, I'm the better looking one. So
There you go.
click on that one.
What's the story behind 7E? I like that name.
Look at my last name.
Oh my gosh. How about that? Wow, you just blew my mind.
So yeah, actually, if I got a minute, there's actually a story behind that. So when I was I think I was actually 7. I was in like second or third grade. I am an awful artist. I can't like draw a stick figure, which our daughter's in school for art, graphic design, and everything, and animation. So it's kind of comical. But we had to do a coat of arms. And my father basically said, hey, let's do one. And we'll do the number 7 in the letter E. And I'm like, that is freaking awesome. You can take your last name and just form it into something. And
Not everybody could do that.
no, and I take a lot of pride in my family's name because, my uncle was killed in Vietnam. There are a lot of, people who served in the military within my family. So it's kind of one of those things as kind of old school guy, you take pride in your name.
Sure.
So when I was starting my own company, eventually I'm like, okay, what am I going to name it? And I was like, and especially it was right before I started naming it, and my father was really sick and ended up passing away not too long after. But I was like, okay, let me steal what I did in, third grade or second grade and just run with it. And you don't know how many people, like a month later will basically call me up and basically like, oh my God, I get it. I figured it out. And I'm like, oh, you figured out it's, that's my name?
Yeah.
That guru who scams all the people for note investing, to this day, will still, if he says my name, will say Chris Seveney with 7E Investments. And I'm like, and I've told him 100, at the time previously 100 times, like,
Well, it's a twofer there. You remember both your company name and your last name all in once. And if you don't know, that's what I was thinking I was doing. I was pronouncing your last name wrong in my head. So there you go. I love that.
so, and again, I'm bad at sales and marketing, I guess. So, I make it easy on myself for people to remember me. There it is.
I think you're very good at it, and I think being real is more important than anything. And you're very down to earth, and very much enjoyed a conversation with you. I look forward to continuing it. And for the listeners, please be sure to check out Chris's. It's fun to check out his podcast. I'm sure there's a lot of great information there, and we'll link all that in the comments and things like that too. So Chris, had a lot of fun with you. Thanks for coming on and talking to me this morning.
Oh, thanks for having me, Peter.